Okay, welcome back to Accounting 410, Chapter 9. Oops, just minimize my screen. Uh, all right. Business income, deductions, and accounting methods. Nice introductory chapter to people that are self employed, people that will be selling, so will be using Schedule C to report their business income and deductions. Once again, that is Schedule D. Okay, and again, business income, just like we individual income, the code defines it as sort of a very broad, all-inclusive definition. Income from whatever source, even if you're bartering anything, the difference in the fair market values would be income to one party or the other. Um, Again, everything is taxable income unless specifically excluded by the statutory uh, regulations. See, all income from whatever source derived. Okay. Uh, a small business. I love love these definitions. The gross receipts test. And again, these numbers are periodically increased for inflation. But a small business is defined by the IRS as a business that meets the gross receipts test. If the average annual gross receipts, so we're talking just income revenues, for 3 prior years does not exceed $26 million. Okay. They give you an example there. Somebody had 24 million in 1 year, 25 million and 29 million in 2018, 2019, 2020, respectively. It would meet the gross receipts test for 2021. So it's an average over 3 years. And it can be, this definition, you're up there pretty high to get up to $26 million in revenue. It's pretty good sized business. So yet they call it a small business. If you have a extraordinary year though with a 3 year database, it can skew the data. But again, it's a rule. So if you have 2 years at 10 and 1 year at 100, you're going to exceed the test, the threshold, and be a big business, I guess. Why do we have to have this? Um, when a business hasn't been in existence for 3 years, it is prorated. Okay, and again, certain businesses have to, small businesses get a couple provisions that make it a little bit easier for them to report and file their tax returns. Okay. Now, business deductions. Basic rules. They have to be ordinary. Uh, they have to be incurred in the pursuit of a profitable uh, motive. Doesn't mean you have to make a profit. It just has to be in pursuit of a profit. Okay. Deductions must be ordinary and necessary and reasonable in amount. Like I said, years ago, there was a comedian by the name of Red Skelton. He paid his wife, employed her, and the IRS disallowed the deductions because they said it's a related party transaction. But the comedian, Mr. Skelton, actually prevailed in court. I don't know if it went to tax court or federal court. But they were able to demonstrate that the work she did and the amount she paid were in line with what he would have paid somebody else. Basically, he had her as or employed as his road manager, booking shows, making travel arrangements, getting hotels, all that kind of good stuff, getting a schedule, setting up appearances on radio and TV to support, drum up, to promote wherever he was appearing, and the amount they paid was reasonable. There are other people that will pay family members unreasonable amounts. Those the IRS will disallow. All right. Ordinary and necessary. Again, broad um, words that are not very specific but have a very broad meaning, so they're subject to interpretation. What they will look at is uh, on a industry or business, the type of business, what is common and usual in that industry. Ordinary and necessary is an expense that is normal or appropriate and is helpful to the and conducive to the conduct of business activity. Okay, so that's a pretty broad general definition. Uh, so just about, I'm going to say everything, but a lot of things can be considered under that definition. There are a few, when you see something that's weird or out of the ordinary or unreasonable amount, on your first time you look at it, you're going to say, well, that might be doubtful. And usually your gut is right, your feelings are right, your brain is right. Um, I'm trying to think of an example of, somebody that joins a very exclusive country club to meet people as potential clients, but then never goes there. Just joined it for the prestige of being a member of that club. Uh, that might be, again, you got to look at the specifics of each circumstance on a case by case basis. Okay. Give some examples that are ordinary, necessary. Advertising, car and truck expense. These are things you incur while you're doing a business. I'll give you a good example. Years ago, there was a fellow down the line from here had a junkyard. They had a family member being was getting married, so they wanted to deduct the cost of the wedding as a business expense. Clearly not allowable. That's a personal expenditure. Uh, Again, 20 or so years ago, there was a sitting Luzerne County judge who actually got 2 years in jail for he filed tax returns, but he filed erroneous tax returns because he put a lot of personal expenditures. He had a couple of businesses, one of which was he was involved with his cousin on a automobile dealership, and he put his here. I'll give you an example. If you have he had Penn State tickets for the Penn State football team. If they were used to were given to employees who met or exceeded their sales goals or whatever bonus, 10-year anniversary with the company, that is a legitimate business expense. It's a part of an employee compensation plan. However, he used the tickets for himself. Never took a client, never took an employee to the Penn State football games. So it was clearly a personal expense, was disallowed, and was part of the reason he got 2 years free room and board, courtesy of the United States Department of Justice in one of their facilities. So again, you can see the same expenditure, how it was used. Was it used for a personal purpose, or was it used to further the business? And again, in the pursuit of profit, not actually have to be directly tied in result of a profit, but just intended. Okay, so again, guy joins a country club, he takes his friends. Now that's personal. Joins a country club, takes existing or potential clients to play golf. That's business related. Okay. You can look at Schedule C. A lot of these items are listed on the Schedule C. What's allowed and what's not allowed, and what line is it? One of the ones towards the end is a line for miscellaneous, and then on the back of page 2 of Schedule C, you would list them. Again, I used to have a client that owned and trained standard-bred horses, harness racing, and there were a lot of nuances to that business that the expense categories were not listed on page 1 of the Schedule C, between lines, I don't know, 5 or 6 and 20 or 30 it is. So, I would just put on miscellaneous, a big number, and then they give you maybe 8 or 10 lines on page 2, but I would have to attach an additional schedule because you had veterinary bills, you had feed bills, you had transportation costs, you had all paddocks, entry fees, all these different types of expenses that weren't, because it's a niche industry. It's not, the Schedule C is a blanket broad for each and every type of business. And again, they can't make the form 10, 12 pages long. They want to keep it simple. So again, the ones that are on there are probably going to cover 95% of the business expenses, regardless of what type of business you are. Now, he did have a lot of expenses that qualified on between those lines, lines 6 and 20, whatever it is. But again, he had a lot of unique type captions, turnouts, farm, boarding the horses at a farm, give them a rest. Reasonable amount. We just talked about that. And again, if it's a related party transaction, the IRS will look long and hard on it and compare it to other arm's length transactions, what they would have been recorded and transacted at. Read again, that's a really good textbook, well written, with the examples they provide. So read the examples. It really brings the theoretical and the practical together to mesh and gives you a better understanding. And the taxes in the real world. Web sales, again, something that is relatively new, the last 20, 30 years maybe. And again, you got to remember the tax code it's 1971 was the last, or 81 was the last major revision, but it's basically over 100 years old, going back to 1913 was the original IRS code. So they have this Cohen rule they talk about here. The 4th paragraph down, taxpayer with inadequate business records testifies credibly that he incurred certain expenses under the Cohen rule. The court ruled the court can estimate the amount of deductions. The rule originated with George M. Cohen, the Broadway producer and musician. He was a big songwriter for Broadway shows. And that's going back in the 1920s or 30s. Yeah, well, there it is. The court case was 1930. Okay, he was audited by the IRS, which disallowed many of his business and entertainment-related expenses. IRS argued that without receipts, expenses were non-deductible, despite Cohen's credible testimony in court. Second Circuit Court of Appeals agreed with Cohen and forced the IRS to accept estimates of his expenses. Yeah, it's only reasonable that if you're successful and you're generating revenues, that they didn't come out of thin air. You had to incur certain expenditures to do it. However, the court is not required to guess at a number, but it has to have some basis for the estimate. Okay, so again, the point here, the lesson to be learned here is document everything. And if you don't get a receipt, write a note or a memo that says couldn't get a receipt, but incurred, write a check. Again, not everybody will take a check. So it puts a lot of pressure on the taxpayer, but documentation and records are very important, very, very important. Limitation on business deductions. Okay, for a variety of reasons, Congress prohibits limits on certain ones. Things that are what they call contrary to the general welfare, the public policy. Okay, key facts. No business deductions are allowed for expenditures that are against public policy, bribes, or political contributions. Fines and penalties are not deductible for tax purposes. Deductible for financial accounting purposes, but not for tax. So you get one of your delivery people gets a speeding ticket or parking ticket. Yeah, it's an expense to the business for financial accounting purposes, is not deductible for tax purposes. Expenditures that benefit a period longer than 12 months must be capitalized. Now, we'll find out later on that's not 100% true because provision of Section 179 that allows immediate expensing of, I believe, up to $1 million now. They again, back when I started, when that first came out, I think it was $25,000 a year. Now it's up to $1 million. No deductions are allowed for expenditures associated with the production of tax-exempt income. All right. So if you borrow money and the interest for investment purposes, but you invest in tax-free municipal bonds, that interest on that loan is not deductible. If you borrow money to buy stock or whatever type of investment you want to get in, as long as it's not a tax-exempt investment, it's deductible. Personal expenditures are not deductible. Again, later on, we're going to see some things about as a business versus a hobby. Okay, and the IRS see if you make a hobby, it's taxable. If you lose money in a hobby, it's not deductible. Um, Illegal bribes, kickbacks, again, things against public policy. Paying somebody to do harm to another business, industrial espionage. Again, those things are contrary to law, contrary to public policy, are not deductible. Okay. Illegal gambling, selling stolen goods. Okay. Buying stolen property against the law, it can't go into the cost of goods sold. However, most people do that, don't do it well, and some may do it intentionally, willingly. Other times, it's you just a knowing victim. Okay, not allowed to deduct fines, penalties, bribes, or illegal kickbacks. Um, Political contributions and lobbying costs, because that is contrary to public policy, because it kind of upends the level playing field intent that everybody should have the same uh, chance. Capital expenditures, that again, when you buy an asset, and again, for tax purposes, for financial accounting purposes, a lot of companies have policies. Anything over $500, regardless of whether it qualifies for 3-year, 5-year, 10-year, whatever, they will expense it. And again, that is de minimis impact on anything. So it costs you more to set it up as a capital asset and depreciate it than it's worth. Again, we'll get into that in a later chapter on depreciation and cost recovery. And we can also capitalize costs to create or acquire intangible assets, patents, goodwill, startup. Again, same thing, amortization, depreciation. Let's see. Expenses allocated with production of tax-exempt income, not allowable or not deductible, they're allowed. Personal expenditures don't qualify. Okay. Uh, they would be done on your itemized, on your Schedule A itemized deductions. Um, Here's a tricky part. Mixed motive expenditures. Expenditures that have a aspect of business expense and aspects of a personal expense. Um, There's special limits imposed on expenditures that have both personal and business benefits, special rules. Entertainment expenses are generally not deductible. Okay. For 2021 and 2022. So, yeah, you'll have to know that for another year or so, and if you have to file an amended return. The cost of business meals provided, meals uh, in a restaurant, 100% deductible or by a restaurant. This was to help the restaurant industry that got absolutely decimated by COVID when people stopped going out. So they allow them, to again, a very good example of Congress with the two intents of the tax code is to raise revenues for the operations of government. Number two is to influence the economy, and they were trying to help the restaurateurs out here to try and survive during COVID. Um, business meals, not personal meals, are typical limited to a 50% uh, cutoff. You spend $100, you can deduct 50. Contemporaneous written records are required to document that there was a business purpose to the meeting. Okay. Dinner meeting, again, is it? My nephew works in New York City for a law firm. If they stay after, I forget, 6 or 7 o'clock, the law firm will allow them, and they have a percentage they can order out, have meal delivered. Well, to the law firm, that's a deductible expense because you're getting revenue. The employee is working longer than their normal hours, so it's in the pursuit of generating revenues, or it is generating revenues in that case. So a meal like that is for the convenience of the employer, not the employee. So it would be fully deductible. And that would be part of the compensation package. Cost of food and beverages are generally 50% deductible. However, and then they said there's an exception for those 2 years because of the pandemic. Also, fully deductible are the costs of food and beverages when the amounts paid are treated as employee compensation, like I just said with my nephew. For example, a rewards high-performing salesperson with all-inclusive vacation, the cost of the vacation, including the food and beverages, is fully deductible. Beverages, too. Okay, and that means adult beverages as well as soft drinks and milk. So again, you can see where the same expense in different contexts may be 100% deductible or 50% deductible, depending on whether it's reward for an employee for doing good or exceeding a thing. And then if you're just taking everybody or some clients out, then it's only 50%. And the theory there is, well, people have to eat anyway, so it's going to cost them. The next big mixed mode of expense is travel and transportation. Go to a seminar, yeah. But if you stay over the weekend and do some sightseeing, well, then maybe those days are excludable, not deductible. If you take your spouse, or if you extend the vacation, you're going out to Chicago or somewhere for a 3-day seminar, but you stay the week. Well, 3 days, not the week, but you stay Monday through Friday because you want to do some sightseeing. Well, the business portion is deductible Monday, Tuesday, Wednesday. The Thursday and Friday, you're on a frolic of your own because you want to see Chicago. You want to go see a Bulls game or Blackhawks or White Sox or the Cubbies play. That is a personal expense. So those, 3/5 would be deductible and 2/5 would be personal, so it would be non-deductible. The cost of commuting between a home and business is not deductible. Traveling from your one job to a second job is deductible. Okay. If you're going and traveling costs to your normal place of business is commuting. Okay. Traveling to a third location to perform some job duties, that is deductible expense, a travel expense. Myself, years ago, I was teaching for the community college here in Luzerne County. I would go to my day job up in Scranton, and I would go directly from Scranton down to their campus in Nanticoke. That would be deductible. If I came home first on my way from my office in Scranton, parked the car, went in, had supper, changed clothes, whatever, and then down to Nanticoke. Nanticoke, from my house to Nanticoke and back, is a normal commute. It's not, I'd have to go directly from Scranton to Nanticoke. So you got a lot of odds and ends in these things, but again, it's common sense. I had no problem deducting it for state and federal purposes. However, my local tax jurisdiction at the time refused to honor the IRS code. And I said, show me in your legislation where it is not deductible. And she said, well, it's just not. And I showed her publication 17. I documented everything. And they said, no, you're commuting. I said, no, look. And at the time I was working, I was teaching 2 classes. One on Sunday, where I went from my house to the campus and back, that's a commute. During the week, when I went from my house to Scranton directly to campus, and then back home, that was deductible. Not my drive up in the morning, but my drive from the primary job to the secondary job and then back home was deductible. Okay, again, rule is the business related portion is deductible. So you have to allocate it on some reasonable, rational sort of way, which would usually be the number of miles driven. Okay. And again, you can take the actual cost incurred, or you can take IRS will have periodically publish a mileage charge. Now that the gas is up, I don't know what it is offhand. It used to be 44 cents a mile, then it went up to 50, 60 cents a mile. And here it says here it's 56 cents a mile now. And that, that takes into account on an average basis of your depreciation on the vehicle, gas, oil, insurance, and everything else. Again, you want to figure that out, actual costs or the mileage, and take whatever's higher. Take the larger expenditure and give you the best bang for the buck. Again, the example they have there. And again, we'll be talking about other limitations with vehicle expenses, especially when we get into the depreciation chapter, or cost, what they call cost recovery, which is the tax phrase for depreciation. Transportation costs. Again, you got to divvy up between, they treat travel and transportation costs differently. Okay. Transportation is, driving your car, taking a cab or a bus, a train, an airplane, whatever, transportation. Okay. Travel expenses, the cost of meals when you're away from home, again, subject to 50% limitation, lodging, and incidental. So your hotel, your tips to the doorman and bartender and all that. Taxpayers consider to be away from home overnight if the travel is away from the primary place of business and of sufficient duration to require sleep or rest. Typically, this will be overnight. Yeah, when I was a tax auditor, I went all over the country. I was in 27 states in 5 years. Go out to San Francisco. Now I was reimbursed for all my expenditures except alcoholic beverages. If I want to have a glass of beer or a glass of wine with supper, I couldn't deduct that, but I could deduct the cost of it. And again, we had pre-established amounts, and my employer would reimburse me for those. Okay, so I had expenses, but I was also reimbursed for the expenses, so I couldn't deduct them. If they were not reimbursed, I could deduct them on a Form 2106, which I don't know if that still exists. I guess it does. Again, the trip. Primary purpose of the trip depends on the facts and circumstances and often is a subject of dispute. Yeah, so it's debatable. The general rule, is modified somewhat if the trip is abroad. Okay, so again, if you have international travel, the rules change. Don't ask me why. International travel is different from domestic travel within the 48 contiguous in Alaska and Hawaii. Okay. But if the primary trip is personal, the taxpayer may not deduct any transportation costs. Okay. And if the primary purpose of the trip is business related, again, you need to document it. Okay, if the foreign travel is primarily for personal purposes, but you're going to call on a client or a potential client or two, some of it could be deductible. Okay. When foreign travel is primarily for business purposes, a portion of the round trip transportation cost is not deductible. Okay. Non-deductible portion is typically computed based on the time ratio, such as a proportion of personal days to total days. If you go for 10 days and you have a two-day or eight days or personal trip, but 2 days you spend touring a plant or trying to get a customer or a vendor, then 20% would be deductible, 80% is personal. Again, they give an example there to make that a little bit clearer. And they show the computations there. Property use. Several types of property may be used for both business and personal uses. Cell phone, automobiles, laptop computer. My laptop computer I use for both preparing taxes back in the day when I did that for people, and also for personal use. So the amount that I use for business purposes, deductible. Personal, not deductible. Okay. Now again, Most of the paper I used was for tax purposes, very little for personal. So again, you got the computer. It was probably mostly personal because tax season is 3 months out of the year. The other, and you know, 12. I'm using it for personal purposes for 12 months of the year and tax purposes for uh, 9 months a year. If you want to get really accurate, I probably could have kept a log of how much time I was logged on personal totally, and then how much was preparing taxes and doing tax research. That would be give me a fraction that I could take the cost of the computer. Uh, Probably. When you have what they call mixed use property, it's very, very important. It's always important to have proper documentation with mixed use property, even more so. So do it in capitals. Let's see. They use here an example 90%. Full year's expense for the business is $1,000, but the asset is only used for purposes 90% of the time. So 900 of $1,000 can be deductible. Record keeping and other requirements. Because distinguishing business purpose from personal is very difficult and subjective, the tax law includes provisions designed to help the courts and the IRS determine the business element of mixed motive transactions. Taxpayer must maintain specific written contemporaneous records, amount of time, amount, and business purpose. There are companies out there that will sell tax preparers little booklets or folding out pamphlets that you can give to your clients. And again, they'll put your name and on there. It's a dual thing. It promotes your tax preparation business, and it also gives the taxpayer a nice record where just lists all the months of the year with all the dates, a calendar more or less, and you have it's a specially designed calendar where you can write down the mileage, total mileage, and how much was business and the purpose of the business travel. And it's a really nice little thing. You could fold it up, keep it in the glove compartment above your sun visor, or the clients would do it. Okay. Purpose. Amount of deduction in general is limited to the sum of one, the business interest income, and to 30% of the adjusted taxable income. What are we talking about? Interest deduction. Okay. And again, those are, whenever you see a percentage like that, it is subject to change. Limitation does not apply to businesses that qualify as a small business. Okay, so earlier, at the beginning of the lecture chapter, we talked about a small business. So again, if you're under that, you can take the whole amount that's applicable to business, not the 30% cap that is for large businesses. Again, the key facts there, business interest limitation, they got 4 bullets. Please read those. Calculating the interest limitation, I'll walk you through an example there, 11-9. Losses on disposition of business property, okay, generally allowed. Okay, you have an asset, you used it, now time to replace it with a more efficient or a newer model or just plain worn out. And you can, if you traded on a similar asset, you can defer any gain or loss until you sell that new one. But if you do it in an isolated transaction, any gain or loss is reportable. Gain will be taxable, losses will be deductible. Okay, more on that in future chapters on the property disposition, because we have to calculate in any cost recovery. We have to get an adjusted basis. So you buy a machine for $25,000 or a vehicle and you depreciate it for 10, the basis is 15,000. So if you sell it for 15, you break even. Sell it for more, you have a gain. You sell it for less than 15,000, you have a loss. Business casualty losses, that occurs sometimes, but again, it would be the net of any insurance recovery. Okay, they can be deductible when the assets are stolen, damaged, or completely destroyed by a force outside the control of the business: fire, flood, or earthquake, tornado, what have you. casualty losses. Businesses deduct casualty losses in the year the casualty occurs, or in the case of theft, the one it is discovered that is missing. The amount of loss depends on whether the asset is completely destroyed or only partially destroyed. Watch out for that one. When it's completely destroyed or stolen, the business calculates the loss by substituting the insurance proceeds, if any, from the amount realized. Okay, that should be subtracting, not substituting. This is the loss, the amount of insurance proceeds minus the adjusted tax basis of the asset. Okay, so let's say we had the vehicle, $25,000 cost, $10,000 depreciation. So the insurance recovery is $10,000. So we had a $5,000 loss. The insurance recovery is $17,000. If we had an inflation rider to replace the vehicle, well, then we don't have a loss. We don't deduct it. And the replacement vehicle would be adjusted. That $2,000 or $2,500 proceeds exceeding the basis would be adjustment to the basis of the new asset. If the asset is damaged but not completely destroyed, the amount of the loss is the amount of the insurance proceeds minus the lesser of the asset's adjusted tax basis. That's usually the cost less depreciation, or the decline in value of the asset due to the casualty. Okay. Turn the page here. Turn 2 pages. Accounting periods. Again, most businesses use a calendar year, which no problem. Okay, full year is a 12-month period. Some businesses can use a fiscal year. Many retail stores use a fiscal year ending January 31st because in the retail industry, Christmas is the very busy season, and they use the month of January, the last week of December and the month of January for returns and also for sales to reduce their inventory. Okay, if you're a fuel oil dealer, you probably want to have a June 30th fiscal year ended because you're busy during the winter and you want a time, a little breathing space to do your closing entries and get everything when you're not as hectic. Things that are a little bit slower. There's also a thing called a short tax year. If you get bought out or go out of business, you can file a short tax year, less than a 12-month period. Okay. A business may report income for a short period in its first year of existence or in its last year of existence. Also, if it merges with another company, you might have to close out for a period less than 12 months. 3 types of tax years they list there. Calendar year, which is any year ends on December 31st. The fiscal year is a 12-month period that ends on any day other than December 31. And they usually go with a month end, but not always. And then they have what they call a 52-53 week year. Well, when I was training as a tax auditor, I saw maybe 1 or 2 of those, and I was looking at 20. I was probably looking at, when I was starting out, quite a bit, and then when you get to the bigger companies, it slows down. But I was looking at anywhere from 30 to 100 tax returns a week, reviewing them. And I was doing that for a good portion of 4 to 6 months. And I only encountered maybe a handful of those 52, 53 week period. And that's a fiscal year that ends on the same day of the week each year. And because the calendar is not an even thing with 365 days, 365 divided by 12, that's 30.4 weeks or 30.4 days per month. I don't know of any month that has 30.4 days. I know there's February that it can have 28 or 29. Then there's 4 months that have 30 days and the rest have 31. So some businesses like to end on the same day every year. So because of that variability of the Julian calendar, I guess it is. Yeah. Every now and then you'll have a 50, most of the times you'll have a 52-week year, but every now and then, every 5, 6 years, you're going to have a 53-week year. Okay. And give you an example in there when I talk about those things, like I said, however, are kind of rare. I can't even remember the types of businesses that I encountered because, like I said, must have looked at over 1,000 tax returns when I was training, and I can only remember a handful or less of those. Okay, accounting periods. Individuals and proprietorships generally use a calendar year. Okay, now there's kind of rules there for that's individual's proprietor. An individual proprietorship is an individual owner. Corporations are allowed to choose a fiscal year. Partnerships and other flow-through entities, that would be LLCs if they choose to, and that would be it, yeah. LLC can file as a partnership or as a corporation. So if they choose to be treated as a partnership, they can choose a fiscal year. And subchapter S could be a fiscal year, and generally use a tax year consistent with the owner's tax years. Now, the owners can be a corporation, which has a fiscal year, or it can be an individual, or it could be another partnership. Last weekend or the weekend before last, I did a preliminary workup on my taxes. I have one investment in a limited partnership, and it's up in New England. And I was waiting and waiting and waiting because they have to get their tax return in by March 15th, and then they have 30 days from that, or 28 days from that, to get me my K1, which is my share of all their revenue and expense items, so I can put on my personal return. Yeah, I was waiting for it, and I thought maybe they forgot about me, and I finally got it, so I was able to do my return and get everything together. And I told my wife, we are, what were we? 0, a thousandth. I think we are 11,000th owner in that partnership. So yeah, they have quite a few partners. That's a big partner, limited partnership. Sole proprietorships, again, based on the calendar year reported by the owner, because individual proprietors must report their income. Proprietorships use a calendar year, just like the individual. Flow-through entities, partnerships, and S corporations generally adopt a tax year consistent with that of the owners, because the owners, and again, different owners could have different things you do with the majority owners, the majority of the owners. C Corps are generally allowed to select the calendar year, fiscal year, or the 52, 53-week year. Business adopts a calendar year or fiscal year by filing its initial return. So, it's not anything difficult. You just check it off on your first return and on the box up the top. And in contracts, a business that takes a 52, 53 has to file a special election with the IRS to put them on notice. Okay, once an entity selects their accounting period for tax purposes, they have to stay with that one. They have to be consistent. If they can change, but they need to get permission from the IRS, written permission. They have to make I don't know if there's a form involved in that. I believe there is. And you have to get a reply that the IRS allows it. Okay? Now, the implication there is different years have different rates and different rules. So can get messy, can get complicated. Accounting methods. Well, what do we have here? Cash basis or accrual basis, basically. And they also have what they call a hybrid basis. Financial accounting rules are out the window because we're talking tax code here. The tax code is what governs. We're not following GAAP. We are following the tax code. Okay. But even under the tax code, we reporting in statement income businesses have incentives to select accounting methods permissible under GAAP that accelerate income and defer deduction. Well, that doesn't exist for IRS purposes. Okay. In contrast, businesses have incentive for choosing accounting methods that defer income and accelerate deductions for tax purposes. Okay, so there's a getting pulled in different directions here. Accounting method, most taxpayer individuals cash basis. Okay, the IRS likes the cash basis, especially on certain items when you have like installment sales. Okay, now business has to choose a method, and it must be one that clearly reflects income and must be applied consistently. Okay. So they're basically looking at the cash or the accrual. They're generally free to choose which one, but C corporations and partnership with C corporation partners are generally required to use the accrual method if they do not qualify as a small business. That's why we had that thing that seemed silly at the beginning of the chapter, the $26 million average for 3 years, 26 million average for 3 years. Again, you could be over and under, but if the average comes out to 26 million, then you don't have to comply with the accrual method. Okay, businesses qualify under the gross receipts test do not need to request consent to select the cash basis. Okay, they may also choose the hybrid. Some accounts are on the cash basis, some are on the accrual basis of accounting. Okay, so, yeah. Cash method is pretty straightforward. Again, they have this thing called the 12-month rule. So if you have regulation allows prepaid business expenses to currently deducted when the contract does not extend beyond the 12-month period, and the contract period does not extend beyond the end of the tax year following the year of the prepayment. The year following the prepayment. So prepayments for a duration of 12. Again, it'd be nice if everybody that had prepayments had those prepayments on January 1 and they only expired on December 31. That's not the case. So you can deduct it a year, you make it if it's for a 12-month period or not. Accrual method. They follow very similar to GAAP except for two basic differences. Okay. First, requirements recognizing taxable income tends to be structured to recognize income earlier than the recognition rules for financial purposes. Secondly, the requirement for accruing tax deductions tend to be structured to recognize less accrued expenses than the recognition rules for financial. So you have it a little bit modified. Okay. And again, the IRS is very suspicious of people trying to use different accounting methods, again, to defer income and accelerate deductions so they can somewhat manipulate their income, their taxable income, and at least defer it. On the other hand, the IRS and the government all want to write the tax law to collect the most revenues as quickly as possible. Okay. Accrual income, all events test for income. All events that have occurred that determine or fix the right to receive the income and the amount of the income can be determined with reasonable accuracy. And they give you 3 dates. When they complete the task required to earn the income, when the payment for the task is due, doesn't have to be paid, just has to be due, set up as a receivable, and when the business receives payment for the task. Okay. Taxation of advance payments, unearned income. Okay. Sometimes the taxpayer gets paid before they earn it. Well, yeah, that's no problem for financial accounting purposes, but for tax purposes, what do? Taxpayers using cash method must include these payments in gross income in the year it is received. Okay. Completely different from financial accounting. When accrual method, taxpayer must include unearned income, and gross income depends in part on the type of income. Okay? They must recognize interest and rental income immediately upon receipt. And then they have the key facts there with the 4 bullet points. For other types of income, the accrual method basis can elect to defer recognition of unearned income for 1 year. And the using accrual method may elect to defer recognizing advance payments for goods or services until the next year. This 1 year deferral does not apply if the income is actually earned by the end of the year of receipt, or if the unearned income is recognized for financial reporting purposes. So again, it's the exception to the rules and the exception to the exceptions. Inventory. When you have inventory, I believe you have to have the accrual basis or hybrid, can't use cash. And you have these uniform capitalization rules called UNICAP. It specifies that inventory must be accounted for using the full absorption rules to allocate the indirect costs of productive activities to inventory. That, of course, would be for manufacturers. Okay. Inventories. Key facts. C Corps and partnerships with C Corp partners must use the accrual method to account for inventories unless they qualify as a small business under the gross receipts test. So again, gross 26 million average for 3 years. You don't have to comply with this. UNICAP rules require capitalization of most indirect costs of production, but businesses that qualify as a small business are exempt. LIFO method is allowed if it's also used for financial reporting purposes. So again, inventories, if you're a manufacturer, your inventory, you're going to have direct material, direct labor, and overhead. So it can get a little bit sticky there. Uniform capital. Okay, it's just continuing on about the inventories. Inventory cash flow method. Once it determines the cost of its inventory, it must use an inventory cost flow method to determine its cost of good. We know these from financial accounting. First